Something extraordinary happened today, and most people have absolutely no idea it did. Not because it wasn't important, not because it wasn't public, but because when events like this occur, they don't come with flashing lights or emergency alerts. They come quietly, wrapped in policy language, delivered in formal rooms, and then buried under headlines that completely miss the point. Earlier today, standing at the U.S. State Department in front of representatives from more than 50 nations, the Vice President of the United States said 5 words that may end up being remembered as the moment the silver market fundamentally changed forever. Not suggested, not debated, not explored, declared. The United States will establish price floors, not might, not maybe, will. That single sentence, delivered calmly and without drama, just altered the risk structure of one of the most manipulated commodities on Earth. And if you own physical silver, whether it's in a safe, a vault, an IRA, or a tube of Eagles you bought years ago while everyone laughed at you, you need to understand what just happened. Because the government of the most powerful nation on Earth just told the world something very specific. They want silver to cost more, not less, not stable, more. And they are willing to use the full weight of U.S. trade policy to make sure it happens. The mechanism is not complicated, but the implications are enormous. Adjustable tariffs. If foreign producers attempt to dump silver into U.S. markets at prices below a government-defined reference level, tariffs automatically activate to push the effective price back above the floor. No emergency vote, no congressional gridlock, no negotiations with individual companies, just a switch. That alone would be historic. But this didn't happen in isolation. It happened at a moment when silver has quietly crossed a line it has never crossed before in modern American history. In November 2025, silver was officially placed on the U.S. critical minerals list. Think about that. Not during World War II, when hundreds of millions of ounces were borrowed from national reserves to build atomic weapons. Not during the Cold War. Not during oil embargoes, currency crises, or global conflicts. Now, that classification is not symbolic. It unlocks federal authority to stockpile, subsidize, fast-track permits, intervene in pricing, and treat supply disruptions as national security threats. Silver is now in the same legal category as uranium. And once you understand why, the price floor announcement stops sounding like speculation and starts sounding inevitable. For 5 consecutive years, the world has consumed more silver than it has produced. Not once, not occasionally, every single year. The cumulative deficit is now roughly 820 million ounces. That is not an abstract number. That is nearly a full year of global mine production that simply does not exist anymore. Used, destroyed, embedded into solar panels, electronics, medical equipment, data centers, and weapon systems. And here is the part that almost nobody understands. Over 70% of silver is not mined because someone wants silver. It is mined as a byproduct of copper, zinc, and lead. Which means higher silver prices do not automatically create higher silver supply. There is no emergency lever. There is no rapid response. You cannot just turn on silver production. The supply is rigid, demand is not. Now add something else to that equation. The futures market, paper silver, claims on silver that outnumber physical ounces by hundreds to 1. Depending on the estimate, roughly 300 to 350 paper claims exist for every single ounce of physical silver that can actually be delivered. That system only works under one assumption, that prices can move freely downward. Short sellers survive because they believe the price can be forced lower, rolled, suppressed, managed. But what happens when the government publicly announces that it will not allow prices to fall below a certain level? The risk profile collapses. For a short seller, upside is now capped by policy. Downside is unlimited. You're no longer trading against other market participants. You are trading against the U.S. government. That is not a trade. That is a mistake. And if those shorts begin to unwind, the math does not allow for an orderly exit. There's not enough physical silver in registered inventories to satisfy delivery. COMEX stocks are down dramatically from their 2020 highs. London inventories have been bleeding metal for years. Shanghai inventories are near multi-year lows. The silver is not sitting in vaults. It is sitting inside products that will never be melted down. And just as this pressure is building, China made its move. At the beginning of this year, China imposed new restrictions on silver exports. Only a small number of state-approved firms are now allowed to sell refined silver to global markets. Hundreds of private refiners were effectively cut off overnight. China controls the majority of the world's refined silver capacity. Their own media described the policy as an upgrade of silver from a commercial commodity to a strategic resource. If that language sounds familiar, it should. It is the same language used before rare earth export restrictions were imposed. And when China does that, it is never temporary. The U.S. response was not rhetorical, it was structural. Gone. Multiply that by decades. A trading bloc is now being assembled. Allied nations, mining nations, industrial partners. A system designed to secure supply, guarantee pricing, and shield participants from external manipulation. Countries like Mexico, Peru, Australia, Chile, major silver producers, countries that benefit from higher prices, not lower ones. Inside the bloc, supply is protected. Outside the bloc, tariffs apply. That is not a trade dispute. That is a siege strategy. And then came Project Vault, quietly launched, almost no mainstream coverage, $12 billion dedicated to critical mineral stockpiling, backed by the Export-Import Bank, 15-year commitments, oversubscribed by private capital. And look at the participants: defense contractors, automakers, aerospace firms, and Google. Ask yourself why one of the largest technology companies in the world is participating in a physical mineral stockpile. Because data centers are silver intensive. AI infrastructure consumes enormous quantities of high-purity silver. Every advanced server requires significantly more silver than previous generations. Google is not speculating. Google is securing supply. When technology giants start behaving like Cold War defense planners, something has changed, and the structure of the program matters. Participants receive guaranteed access to physical metal at predetermined prices. That is a price floor embedded into the real economy, not paper contracts, not futures, physical metal. This is policy locking itself into the supply chain. Now look at price action. Silver did something in the past year that should make any serious investor stop and think. It nearly quadrupled. Then it suffered one of the most violent single-day crashes in modern history, and then it recovered most of the loss in days. Assets that behave like that are not toys. They are under stress. Different banks see different futures. Some see a correction. Some see triple digits again. Others call it a bubble. But bubbles do not get national security designations. Bubbles do not trigger government stockpiles. Bubbles do not provoke export restrictions from China. And bubbles do not cause vice presidents to announce price floors in front of 50 nations. What we are watching is not speculation. It is a realignment. Now let's address the question everyone asks, and almost everyone asks it the wrong way. Is $1,000 silver coming? Not tomorrow. Not next week. Probably not this year. But asking whether it is crazy misses the point. A year ago, silver was barely above $30. Few believed it could triple. It did. Few believed it could be declared critical. It was. Few believed governments would openly intervene to support pricing. They have. History does not move in straight lines. It moves in shocks. Gold at $10,000 is no longer considered fringe by major research firms. If that happens, silver does not stay where it is. Ratios compress. Scarcity asserts itself. Industrial demand does not negotiate. And here's the most unsettling part of all. The official supply deficit numbers do not include military consumption. In the mid-1990s, U.S. government agencies stopped reporting silver usage related to defense. No explanation, just silence. Missiles, satellites, radar, naval systems, none of it is counted. Every cruise missile that has ever been fired contains silver that is permanently removed from the global supply, destroyed, vaporized. The real deficit is unknowable, but the government knows, and governments do not move like this unless the numbers scare them. A price floor does not eliminate volatility. It does not prevent pullbacks. It does not make silver risk-free, but it does something unprecedented. It limits downside through policy while leaving upside governed by physics. That combination has never existed for silver, not once. And that is why this moment matters. Because markets will eventually understand what was said today. And when they do, the repricing will not ask for permission. The only real question left is whether people realize what just happened before the rest of the world does.